2025 is going to be one of the best years for the stock market. And if you watch this video carefully, I'm going to explain to you how exactly you can profit from 2025. Because what's about to happen is an opportunity that everybody who is watching this video should profit. So make sure that you pay attention. Now, if you look at how most people analyze stocks, especially on social media, what they try to do is that they try to look at the history of the stock and they'll try to analyze the chart in order to predict where the stock is going to be a few months from now, or maybe even a year from now. But the problem is that even though that historical data is a great indication of the future, it isn't always right. Because what happened in the past has happened in the past. And there are a lot of other factors that could happen today in order to divert the stock into a completely different direction. So if we want to understand where the stock market is going to be, for example, 6 months from now, we should not look at the historical data and the charts and numbers. What we should take a look at that, the stock market, even though that it's a giant mechanism, it's at the end of the day a system. And any system works within some framework or rules that kind of guides that system in the first place. And if you understand how that system works, and if you understand the rules that actually guide that system, you will be able to understand where the output of that system is going to be. So any system contains or consists, I would say, of an input, like something that goes into the system, and then there is a process, and then there is an output. And so if you understand what is the input, and if you understand the rules upon which the process actually works in the system, you will be able to predict the output. If we talk about the short term, it's impossible to do that because the number of factors that influences the market or any other particular stock are so many that you simply or physically, I would say, don't have the time to include them in your decision making, which is why whatever decision you take in the short run is very difficult for it to be accurate. Yes, you can be lucky to a certain extent if you get most of them right, but most of the time you lose. And if you kind of pull out the statistics of the short-term traders, you'll find out that the vast majority of them lose. But if you zoom out and take a general look at the stock market, you will realize that there are a certain huge main factors that simply drive the stock market into one direction or another. And that's not just about the stock market overall, but any other particular stock. And what we want to do is that we want to figure out these main factors that drive the market. And these are the main factors upon which the entire system works with. So if you take a look at any stock, if you Google any stock right now, you'll find out that, like what most people do is that they will try to look at the price, they will like to look at the movement of the chart, it went down, it went up, whatever. But you have to understand that behind every single stock, like there is a real business. Now let me change the color here, I like the red. Behind every single stock, there is a business, and that is a real business. And that business could produce iPhones, that business could produce some kind of a software or an application, or it might have factories all across the globe, ships in order to build their logistics. But as an investor, you don't really care about the business overall. Yes, when you start a business as an entrepreneur or a business owner, you might have other motives. You might want to solve a problem. You might want to make the world a better place. Yes, you also want to make money in the process, but often there are other goals that you have alongside of building a business. But from the perspective of an investor, we don't really care about all those factors, even though that they're important. Now, I don't want to sound egoistic, but from the point of view of an investor, any single business is a printing machine. So when you look at the business, what you see is that you see a printing machine. And the question you want to ask yourself as an investor is that if I'm going to put an X amount of money into this printing machine, how much more money this printing machine is going to print? And the value of that printing machine depends on how much cash it can produce in the future. Let's say that it can print $1 million. Can this printing machine cost less than $1 million? Well, absolutely not, because it has the power to print at least $1 million. So we can say for a fact that the value of this printing machine is at least $1 million. And that's exactly how investors approach any business. They look at the business and they ask themselves a very simple, obvious question. How much money can this business print? How much money can this printing machine print? And if it can print an X amount of money, let's say we figure that out, then this business cannot possibly worth less than the amount that it will print in the future. And that's the perspective you need to have in your mind in order for you to value businesses in the market. So let's take an example in order for us to understand what we mean here. Let's say that we have company A, and this company A is going to make $5 million within the next 5 years. And for the sake of simplification, let's say that each year, let's divide this $5 million for every single year. So year 1 is going to be $1 million, year 2 is going to be $1 million, year 3 as well $1 million, year 4 and year 5. So every single year for the next 5 years, the business is going to make $1 million each. So if we kind of think about it logically, if you buy this business, if you invest in this business should not worth less than $5 million, because we know for a fact that this business is going to make $5 million. But what we have to understand about this case is that even though that on paper it seems like this business should not worth less than $5 million, there is a catch. That a dollar today worth more than a dollar tomorrow. If you have $1 today, you can invest it in the stock market. You can put it in the bank and receive interest. But if you get that dollar, for example, 12 months from now or 2 years from now, then you have missed the opportunity to earn interest on that dollar. And that is the very simple logic behind that a dollar today worth than a dollar tomorrow. Now, another thing to consider is that we have a concept called inflation, which means that prices every single year rise. And when prices rise, the dollars that you have in your pocket lose their value, which means that with a dollar today, you can buy more than you can actually buy with a dollar a year from now or 2 years from now. I mean, think about it. Back when I was a kid, $100 was like a lot of money. Like I remember when I was like a teenager, 12, 13 years old, and $100 was like it was literally a fortune back then. But today, $100 barely can get you anything, right? And that's because we had inflation every single year for all of those periods. And that's why if you think about it, if this business is going to make $5 million within the next 5 years, in reality, if you do the math, it doesn't worth $5 million. It worth less than that. So we have to do the math and figure out how much does $5 million 5 years from now worth today. And if you kind of figure that out, then you can actually find out the true value of this printing machine or this business that we're actually trying to analyze. So if you factor in interest rate, inflation, and other factors, you'll find out that those $5 million should worth a lot less. And there is a very simple formula that can actually help us understand how much those $5 million worth today. And we call it DCF, or the discounted cash flow. And the way we kind of do the math is very simple, is that we take the cash flow, the free cash flow that the business is going to make, for example, a year from now, and we divide it by 1 plus R. R is our discounted rate. And the discounted rate is the rate at which we believe that those $5 million should be discounted. So for example, if inflation is 5%, then R should be at least 5%. But it's not just inflation that we have to consider. We have to consider interest rates as well. We have to consider other factors that influences the discounted rate. But for the sake of simplicity, in order for us to understand the point, the discounted rate that I'm going to use in this example is going to be the interest rates that are set by the Fed. And I'm recording this video 23rd of August 2024. And the interest rate at this point should be 5.5%. So if we take the discounted rate 5.5%, then we have to check the cash flow for every single year, and we have to discount it by 5.5%, and then we'll figure out the true value of that business. Now, I know that it might not make a lot of sense to you right now, but let's do the math, and then it will actually make sense at the end of the day. Trust me, it will make sense, and it will explain a lot of things to you about the market. So if we take the discounted cash flow, for example, for the first year, and we are about to make, let me change this for a second. Let's do this. First year, we are going to make $1 million. In fact, every single year, we are going to make $1 million. And the reason we chose this number is just to simplify everything for it to make sense to us. So $1 million divided by 1 plus 0.055. And why? Because that is what 5.5% actually is. In the power of 1. Why in the power of 1? Because it's year 1. So if we do year 2, then it is going to be in the power of 2. So the same thing simply repeats, but in the power of 2. And then in year 3, the same thing basically repeats, but in this case, because it's year 3, it is going to be in the power of 3. And so on and so forth for every single year. So if we find the present value of that future cash flow, the value of that future cash flow in today's dollars, we'll find out that if our discounted rate is 5.5%, then the value of that $1 million is going to be $947,867. So it's not $1 million. It's $947,867,000. And $1 million 2 years from now that company A is going to make is going to be $898,452. So that is significantly less than $1 million, like by over $100,000, and that's serious money. Year 3, if we find the present value of $1 million, it is going to be $851,613. Year 4, it's going to be a little over $800,000, and year 5, it's going to be $765,164,000. So if you can see that 5 years from now, yes, on paper, it's still $1 million. And if anyone looks at it, he will call it $1 million. But if we actually take that number, tweak it a little bit, and find out its value in today's dollars as of 2024, when I'm recording this video, then it's not $1 million. It's actually $765,000 given the factors that we have today on our hands. So if we kind of combine all of these values together in order for us to find how much actually company A is going to make 5 years from now, it is going to be $4.2 million, or to be more precise, $4,270,284. So if we want to find out the true value of company A, what is the company A? Yeah. If we want to find out, if we treat company A as a printing machine, and we know for a fact that it's going to make $5 million within the next 5 years, then it shouldn't worth at least $5 million. It should worth at least the amount that we have found after considering other factors, which is $4.2 million. And that's why if you approach the businesses from this perspective, then you know how to value businesses. Now, at this point, you might actually came across this formula before, and you might actually know how to do that. But that's not the point. The point is that what happens when the Federal Reserve tweaks the interest rates? What happens when the Fed changes the rates? Now, we have a lot of news right now that Jay Powell and his team, the chairman of the Fed, are actually thinking to lower the rates this year, next month in September, and even to lower them twice this year. So let's take the exact same formula and apply it when the Fed lowers the rates. Now, for the sake of simplicity, again, we are going to assume that the Fed is going to lower the rates by 2.5%. So the new discounted rate in this case is going to be 3%. The first example we did was 5.5%. Now the second example we're going to make is going to be 3%. So at 3%, if we take the exact same example, which is $1 million for the next 5 years, in the first year, $1 million in the power of 1, it is going to be $970,873,000. Now suddenly, if you remember in the first case where we had our discounted rate at 5.5%, you can clearly see that. Let me scroll that and show you that it was $947,000. Suddenly, $1 million that we will make a year from now worth more on paper. Now, in the second year, if we do the exact same math here, we find out that $1 million 2 years from now is going to worth $942,595. And if we do the math, the exact same math for every single year, I'm going to just say them, but you can see them clearly on the screen, hopefully. And if you add them up, all these numbers, you will find out that our total amount of money that company A is going to make, the free cash flow that it will have within the next 5 years is going to be $4,579,707. Now, you might ask yourself a very simple question. So what? But take a moment and compare these two numbers. The first number, when our rate was 5.5%, the value of the $5 million was $4.2 million. But when the Fed lowered the rates to 3%, the value of that $4.2 million suddenly on paper rose to $4.5 million. Nothing absolutely changed. But just because the Fed lowered the rates, on paper, the value of the free cash flow that company A is going to make suddenly rose. And what that tells you about the business? Now, if you as an investor value a business as a printing machine that's supposed to print money and you're basically investing in that business, suddenly on paper, this company worth a lot more than it used to worth in the past. Now, of course, there are other factors other ways by that lowering the rates would influences the market, because that will give the companies access to cheaper capital that will help them to take that money, invest it in other projects. But that's all secondary. Even if the Fed lowers the rates, that doesn't mean that the company is going to borrow more money. It might not even have the ability to borrow more money, whatever the reasons could be. But just because the Fed lowered the rates, on paper, it is making its future cash flow more valuable, which means that it should reflect on its stock price. So when that more money in the future is going to reflect in its stock price, that means that the stock should rise. That's basically the logical sequence of action that should happen when the Fed lowers the rates. And that's why when the Fed lowers the rates, what will happen to all of those companies? Their stock prices will rise even if they don't borrow any money from the Fed or the bank or any kind of loans at all. And that's exactly what you should be asking yourself. Which stocks are going to rise when the Fed is going to lower the rates? Now, if you look at the companies in the market, you will realize that there are often like two main types of companies. One is huge stable companies that have actually taken their place already and they're making a lot of money. Now, think of Johnson & Johnson. It's one of the largest companies in the world. It has been around for over probably 100 years, and it's a market leader in its segment, and they don't really promise to revolutionize the world. They have a stable business model, and they just keep doing whatever they are doing. Or take ExxonMobil. It's one of the largest companies that extracts oil from all across the world, and it makes a lot of money. Now, compare ExxonMobil to a company like Tesla. Tesla, it makes money, but it doesn't really make a lot of money. The whole point of Tesla is that within the next 10 or 20 years, Tesla is going to build 20, 100 or 50 gigafactories across the world. And when they build all of those gigafactories, they will be able to produce a lot more cars, and their profits will actually soar to hundreds of billions of dollars, probably trillions of dollars. So the point that Tesla is going to make is that yes, we are not making a lot of money now, but we will make a lot of money in the future. So if they make a lot of money in the future, according to experts, for example, what do you think happens to the value of that future cash flow that Tesla is going to make, for example, when the Fed lowers the rates? On paper, its value is going to rise. What happens to a company like Amazon that is not really making a lot of money? Yes, they're making billions of dollars, but they're still expecting to make a lot of money in the future. Suddenly, the money that they're going to make in the future, their true value based on the present value, because the Fed lowered the rates, actually rises. So when the Fed lowers the rates, what happens to the companies that promise to make a lot of money in the future, which are tech companies, software companies, any kind of companies that are investing a lot in themselves today and are expected to make a lot of money in the future, their stock prices suddenly rise. And that's why if you go back to 2020, when the Fed lowered the rates to literally 0%, even the companies that did not borrow as much money as they could possibly can, their stock prices rose. Why? It's as simple as that. Because the value of their future cash flow on paper suddenly became more valuable just because the circumstances of the market has changed. And that's why we have to ask ourselves a very simple question. What are the chances that the Fed is going to lower the rates in September or December or next year? Now, to answer that question, you have to ask yourself a different question. And that is, what is the job of the Fed? Like, why does the Fed exist? Now, there are a lot of conspiracy theories and a lot of theories, different kind of theories, I would say, about the job of the Fed. But we are not going to get into those details because the main job of the Fed is to make sure that there is price stability in the market, which means that inflation doesn't get out of hand. And the second most important job of the Fed is to make sure that there is economic sustainability in the country, which means that the economy simply grows stably. So, for example, if the economy suddenly starts kind of drifting into a recession, the job of the Fed is to manipulate the market in such a way that it kind of pushes the economy and forces it to grow again. On the other side, if let's say, for example, that the economy starts growing too fast and it turns into a bubble, the Fed knows that the consequences of any bubble is going to be a catastrophic crash, which is why the Fed will try to slow down the economy. That's basically the job of the Fed. So if we kind of take these two factors, we will be able to understand what is going to be the next move of the Fed. We might not be able to do it perfectly and understand when exactly they will do it, but the more we know about the state of the economy, the more accurately we can actually predict the actions of the Fed. So if you take a look at the US economy at this point, you will realize that one of the most important things we have to take a look is inflation, because the job of the Fed is making sure that prices are stable in the country. So inflation in the United States, if you take a look now, let me change this for a second. Let's just go, If you look at the inflation at the United States, you'll realize that from 2015 up until the end of 2021, inflation was stable at around 2%. It was 1.8%, 2.5%, but it was pretty stable. And then because the Fed lowered the rates, inflation literally shot to the roof to almost 9% in 2022 and 2023. And that's why the interest rates in these 2 years were 5.5%. And the Fed was forced to actually increase them to those levels to stop the inflation. But you can see that starting from 2023, inflation started going down. And it's very clear. And it's very clear if you take a look at the numbers. And within the entire of 2024, inflation has been at around 2.8%, 2.9%, or a little over 3%. And it's clear that based on estimates of all of the experts, it seems like by the end of the year, inflation is going to be 2.9%. And in 2025, inflation is going to go down to 2%. So the Fed has fulfilled its mission. But by raising interest rates and slowing down inflation, the Fed has created another problem. And that problem is very clear in the next chart that you will see. And that is unemployment in the United States. Because the rates are so high, economy slows down. When the economy slows down, companies stop hiring more people because they have less money. And then when they hire less people, there are more unemployed people. Unemployed people means that they don't have money in their pockets in order to spend, and when they spend less money, the economy starts slowing down. And that's why if you Google out right now, you'll find out that there are a ton of experts that are actually saying that the United States is on track in order to hit a recession. And if you kind of look at all factors, it's clear that if the United States keeps actually walking this road, it will hit a recession. But the job of the Fed is to stop it, is to prevent that recession. And that's why the Fed kind of looks at this data and it sees like, oh, look at this, and unemployment has risen to 4.3%. So if we don't lower the rates at this point, or at least next year, then unemployment could reach 7, 8, or 9%. So we will start slowly tweaking the interest rate in such a point where unemployment kind of stabilizes at around 4%, or maybe at best 5%. And these are the indications we have about the Fed, about what the Fed will do. So if you kind of watch the last meeting and the last interviews about Jay Powell, he kind of was actually hinting at the point that there is a possibility that the Fed will actually lower the rates in September. So if you kind of look at the news that are happening right now, you see all experts are actually predicting that the Fed will actually lower the rates this September, and if it doesn't actually lowers it down this September, it might actually do that in December, in the following meeting of the Fed, or I would say the press conference of the Fed. Now, even if the Federal Reserve does not lower the rates this year, it will 100% for a fact will lower them down in 2025 because inflation has cooled down enough in order for the Fed to have that leverage to actually lower the rates. And that's why whether the Fed will lower the rates this year or the beginning of next year, it doesn't really matter. Because on paper, when that lowering rate is going to happen, on paper, all of these companies, their valuation, the value of their future cash flow will suddenly become more valuable and will become more attractive to investors, which means that all of those companies will rise. And if you take a look at the largest companies in the world today, all of them are tech companies. I mean, if you just kind of look at the top 10 companies of the S&P 500, they represent probably like 40% of the entire S&P, and every single one of them, or probably 8 out of 10 of them, are tech companies. And what is the promise of the tech companies? We're investing a lot of money in ourselves today in order to make a lot more money in the future, which means that their future cash flow is going to be a lot more valuable. That's why 2025 is going to be one of the best years for the stock market. So prepare your cash. Get ready, because you will be able to take advantage out of it. And if you don't know which stocks exactly to buy, or if you're just starting to invest, or you want to simply get better at investing, then check out the first link in the description. It's exactly what you need. That's it. Thanks for watching, and I will see you in the next one.